Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 25 minutes, we'll talk about two or three specific facets. One is, as we said, how to create a low-cost portfolio uh, using ETFs, and what proportion, how to go about doing it, what kind of portfolio, what is this whole ETF thing about. So Chintan Haria will be talking about that, and we'll get in Amol Joshi later on to talk about what proportion of ETFs should be there in ideally in a portfolio. Then, of course, we'll talk about an underperforming large cap fund, which is DSP 100, and what's gone wrong there. What should you as an investor do if you are invested in that? Should you change it or should you stay put? And then, of course, Amol Joshi, the guest, will be joining in. Will also be giving a fund recommendation of his choice. But first, we spoke to Chintan Haria just uh, a little earlier in the day, and when he spoke about this whole concept of ETFs and how to build a low-cost portfolio using ETFs. Herein to that conversation. As we told you over the course of the last couple of days, we are going to try and make today's conversation about how to build a low-cost ETF portfolio. A lot of you would know about ETFs entirely. A lot of you might not. I'll ask our guests to give us a broad brush basic as well, and then move on to the subject matter for all of you who know about ETFs, but trying to figure out how to build a low-cost portfolio. What's the optimum way? What is the optimum mix? And how should you judicially switch between, if at all? Chintan Haria, Johnson really needs no introduction from ICICI Pru, but Chintan, good having you. Thanks so much for joining in. Hope all is safe with you.
Thanks, Neeraj. Yes, all good. Yeah, all good.
That's good. So, Chintan, just a broad brush. I mean, people would be wondering, people who are tuning into the mutual fund show thinking, hey, in a mutual fund show, they're talking about ETFs. What are ETFs? How do we go about investing in them?
Yeah, so put it very simply, we are all used to mutual funds and the active mutual fund piece. I think everyone would have been investing in, wherein the fund manager picks and chooses the stocks basis the objective which is laid out in the SID of the scheme. An ETF or an index fund is exactly the same in terms of how the investor would invest or take out from a theory perspective. But the only differences are that instead of an active fund manager buying and selling stocks on a regular basis, on a daily basis, maybe the ETFs or the index funds in India are passive funds, which essentially means that they follow a particular index. And as far as index funds are concerned, the investment and redemption is also same like mutual funds, which they are used to. But in ETFs, it's similar to a stock, wherein you go to the exchange and you can basically buy even a single unit. So essentially, to put it very simply, you can get an entire basket of, let's assume, Nifty 50 or Sensex 30 by buying one unit of that ETF. So it's also democratization, the financialization of India, wherein you don't need to have big bucks or you don't have big money to buy the entire index, right? You can, through one unit, go and buy on the exchange. That's essentially what ETF is. It's giving you ease of buying a complete basket of an index in a very simple manner on the exchange, much like you would do in a stock or a single or equity.
Okay. So, Chintan, the question that comes is to anybody's mind is, there are large cap funds wherein they say that there is a fund manager who will be able to generate alpha over the benchmark, which is the index, right? Usually. So if that is the case, why should somebody look at ETFs?
Yeah, so clearly in India, especially with the long term, if we have seen the funds, which are the active funds, have been able to generate alpha. They've been able to provide alpha. But we are seeing India increase its financialization. We're seeing so many more people, investing in finance. And so one size won't fit all, and one particular product category will not probably fit the need. You need to have probably a best of everything. I'm not for once saying that active fund management in India won't be able to generate alpha. Yes, 2018, 19, and 20 have been difficult years because of the polarization and the top 10 stocks are up 80%, while the rest of the market is probably flat or negative. So it's been something which happened in 1999, which happened in 2007, probably getting reflected right now. But that's not how it will always be. So as an investor, much like you need to have a balanced diet, you need to have all kinds of food on your palate. Similarly, you will have active funds as well as passive funds in your overall basket. And like you have equity, debt, real estate, gold. Similarly, active plus passive will be there. Now, it is up to you how well you are informed and how you can create a basket, or of course, a financial advisor can help you get the best of both worlds. So I wouldn't say one for the other. I would say both are important, and both have a role to play in the investor over a period of time, because you just don't need alpha at times. You sometimes need beta. It's essentially being allocation also towards equity, and that equity allocation as a first step can be easily had through a simple plain vanilla large cap oriented ETF for most investors.
Yeah, so actually for a lot of you might be starting off, ETFs might not be a bad idea considering that the cost factor is low there. And Chintan, I think the point that you were also trying to drive home is that it is not only about equities when you're building a portfolio. It's about having various asset classes. And I reckon that ETFs give the choice to the investors to at least have all kinds of financial assets, or most kinds of financial asset exposure through the exchange traded fund. Can you talk a bit about that? Can you talk about how does one build this low cost portfolio?
Yeah, so while low cost has been highlighted many times in this conversation, yes, that is one of the key criteria, because you're following an index. So essentially the fund management or a fund management portion is not there. You're following an index, and hence the costs are low. And that's globally the trend, and in India also it's catching up. In fact, in 2015-16, when EPFO was allowed to invest in, or rather provident funds were allowed to invest in equities, that's when, in ETFs, that's when the ETF journey in India kind of exploded. And I think in the last 4 to 5 years, we've seen a lot of more products available on the ETF basket, and people also being much more aware. And with the digitalization, the Zerodhas of the world, etc., and phone pays, everyone coming onto the bandwagon in terms of having an access, easy access, which today's millennials or the youngsters can immediately invest upon. ETFs are catching up as an investment option, which are there. Now, your question was how much or what are the options within ETFs as far as asset classes are concerned. So maybe up to 2 years back, the only option which we had was equity and gold. Now, if we see, of course, debt as an option, many options on debt are also coming up. So equity, debt, and gold as of now are available pretty much in terms of the ETF basket. And I'm sure you will see a lot more options coming up in these three categories. And sooner or later, maybe as India evolves, we may have, other commodity ETFs as well, and maybe REITs in which ETFs as well. So it's a wide landscape which is possible. Currently, if I see, it's majority or the majority of the bulk of the AUM is in equity ETFs, followed by gold, and debt is also picking up big time, especially after the government sponsored or I'd say the government backed Bharat Bond ETF, which was there. So that is also something which has picked up, and we'll see that also expanding as we go along.
I think the budget also did something for gold ETFs, right?
So as far as budget is concerned, I don't think they did specifically anything for the gold ETF per se, but they did reduce the import duties, which essentially meant that it is cheaper for you to basically buy gold. So gold prices have fallen, and it's one more opportunity. In fact, if I have to compare last 6 months, it's been an equity rally and a gold. Risk on rally, so gold has come down. So gold, I think from a peak of 56,000 in India has come down to 48,000, while equities then were around 10, 11,000 on the Nifty, and we've reached about 15,000. So roughly a 35-40% underperformance of gold. So this cut in import duty has further made gold more attractive in terms of a diversification asset class. So like we say, 5 to 10% of your assets, if you have in gold, it is not a bad idea. Traditionally, it was in physical gold that people used to invest, but we've seen because of the lockdown and because of the newer generation wanting to invest in financial assets, gold ETF is also one of the preferred choices which investors are investing in.
Got it. So Chintan, let me ask you, if you were starting off building a portfolio by use of ETFs, and let's assume that the mutual fund side is taken care of, because I invest in funds already, or my advisor advises, etc., etc. But if I'm trying to build this portfolio of ETFs, how should I go about doing it? What should I keep in mind? Because I looked at a mail that I got in from ICICI Pru, and it also speaks about how plain vanilla ETFs, and again, I'm referring to cost because it's mentioned. I'm not saying that's the only reason, but that plain vanilla ETFs have the lowest expense ratio. Smart beta funds have a slightly higher one. So if I want to use ETFs, also because of the cost factor being a big factor over a 20-year period, how do I go about doing it?
Yeah, so clearly, Neeraj, the first aspect, and let's get one step back. It need not be ETF or active. The first step should be, what should be my asset allocation? I think we as an asset management company, we were pioneers in that category, and I think we truly believe that asset allocation is the way to long-term wealth creation with lesser risk, and you are never basically chasing the market when you are in asset allocation. So the first step is, based on your risk profile, create an asset allocation. Now 80% equity may be right for you, 40% equity may be right for me, all everything else between you and me also being same, right? So it's each one is own. Whatever you're comfortable, first decide that. Now once you've decided that, okay, 40% in equity I want to be, and the rest 60% I'll be in debt and gold, that 40% which is in equity, whether I want to be in smart beta, whether I want to be in large cap ETFs, whether I want to be in active mid cap, multi cap funds, because I believe that there the fund manager can play a lot in terms of going down the market cap curve as well. Of course, you have index funds around small cap, you have mid cap ETFs also. So the wide variety is there, but the first part is asset allocation. Now, if you want to build a low cost portfolio, it's very simple. Suppose you have 50% equity, 30% debt, and 20% gold as your chosen asset allocation. The 50% which you have in equity, again, you can break it up into, let's say, large cap, I want to be 40% out of that. I want to be flexi cap, another 60%. So you have that option where you select that. Then you have the debt portion. You have liquid ETFs where you can invest your debt portion to start with. And then as and when market gives an opportunity and you want to increase your equity allocation, you can liquidate your liquid ETFs and move into equity ETFs. And gold, like I said, gold ETFs, maybe 10%, maybe 20% of your allocation in gold ETFs, you can simply buy and hold. And again, the most important aspect, after 1 year, suppose markets have done very well and your allocation changes, you need to rebalance it maybe once in a year. And because of the favorable taxation which equity ETFs have, you can basically invest or book profits also and move to debt as and when the opportunity arises. So I think it is like you said, a low cost way of asset allocation in the long run. And today you have all the products and the building blocks in place on the ETF side, be it gold, be it liquid ETF, be it large cap ETFs, be it mid cap ETFs. I think pretty much a lot of options. And you mentioned about smart beta. That's slightly more technical, slightly more, let's say, for the evolved investor. But we are seeing a lot of high net worth individuals and family offices also tilting towards low volatility products, because essentially they want lower risk adjusted returns, higher risk adjusted returns, which is essentially lower volatility and higher returns. So they're tilting towards low vol and alpha low vol kind of products.
Got it. Chintan, last question. Any caveats or anything that should be kept in mind before doing this? Let's assume everybody who's listening to this or otherwise has read about it is convinced that this is how to go about it. Any caveats or anything to keep in mind?
Yeah, so clearly the first and the most important caveat is don't look at the rearview mirror and invest. So today, if someone has seen that from March 2020, equity markets are up 100%, and today you go and invest maybe 50% of AUM because Chintan is saying 50% of the AUM should be in equity, that's not the right model, right? It's something which you apply consistently and you choose the right opportunity to do so. So I would say that don't look at the rearview mirror while you invest. That's the first point. Second point is patience pays in the long run as far as equity investing is concerned. That applies to equity ETFs as well. So the longer you keep, the better it is from a compounding perspective. These are very simple things which you would have heard probably 100 times, but very difficult because of a greed and fear. I myself in March, if I have to look back, I would have never expected markets to do what they have, despite me knowing that the central banks are going to, come up with the bazookas, so to say. And we are here where we are. And today at 15,000, again, I can't forget that the market has gone up 100%, and you need to be cautious, careful that don't increase your equity exposure when markets have doubled, because that may not be the right thing. Having said that, what equity exposure you should be at, that's something which clearly you need to, work with your financial advisor and have a plan. And ETFs, like I said, play a very big role in adding to your overall portfolio mix because of their low cost, because of their ease of execution, and in the long run, they'll help in wealth creation as well. Thank you.
Okay. Thanks, Chintan. Thanks for joining in and giving us your thoughts.
Thank you so much. Thanks, Neeraj.
Thank you. Yeah, well, that is what I was trying to say. Thank you for the first half of the conversation. Now let's get in Amol Joshi to talk about his thoughts on this whole topic and the other topics that we've already told you that Amol will be talking about. Amol, thanks for joining in. Before we get to the funds in conversation, can I ask you about how do you rate ETFs in the portfolio, what percentage of an investor's portfolio should ideally be these ETFs of any nature? Really?
Thanks, Neeraj, for having me. Always a pleasure to speak to you. Coming to the question, Neeraj, I believe for ETFs, these are probably early days, including for product depth as well as market liquidity. What I'm trying to simply say is that there are better alternatives available. I think in the previous conversation, we heard many times about the low cost advantage of ETFs. It is undeniable. ETFs truly have one of the lowest cost mutual fund products that ETFs are. So barring keeping that advantage aside, you still have comparable products. So I would say an index fund which is also available to you at a 10 or 15 basis point cost for the year. These these index funds probably are better substitute for ETFs. I think we are going to touch this topic in detail probably in the later part of the conversation. But suffice to say, I would say ETF, if it's a unique offering, can probably account for a 5-10% of your allocation. Until few years back, this allocation probably was best taken in gold ETFs because gold ETFs typically had lower costs, and gold savings fund, which are in a mutual fund kind of a wrapper or construct, these had cost of in excess of 1 to 1.5%. But after emergence of sovereign gold bonds, I think the case for ETFs has probably got diluted over there as well. Suffice to say, ETFs, keep them on your radar, probably 5 to 10% of the allocation.
Amol, I'm interested in knowing why are you saying that the index funds are better option than an ETF?
Right. Okay. So that's, I think, very important discussion. The reason why I say that is liquidity or depth of the liquidity available. So ETF, as we again the previous conversation was a great primer for all of us. ETFs, as we all know, are exchange traded funds. So you cannot buy these funds as a retail investor, as a small to medium size investor. You cannot buy these funds directly from the fund house. Typically, what you are used to do for your 1,000 rupee SIP or for your 10 lakh rupee purchase, investors across the spectrum, you typically submit your purchase as well as redemption application to the fund house, and fund house during purchase allots you the NAV and units for that particular day of that working day, and during redemption you get NAV, closing NAV of that particular day. By closing NAV, I mean there is only one NAV per day. Now when you buy ETFs, and ETFs being exchange traded funds, you are essentially buying from other ETF sellers, your counterparts on the other side of the terminal, or market makers, right? As a retail investor, most of the times we have noticed that during buy transaction, if the NAV, closing NAV of that index of that day is, let's say, 43 rupees, many times we have found out that ETFs are trading at much higher valuation, as sometimes as high as 1 to 2%. And during sale, of course, the boot is on other foot to use the same. If during the sell transaction, if the 43 rupees is the fair NAV during that time, you are probably going to end up selling at something like 42, 42 and a half, 42 and 42.7, something like that. So the cost factor that it drives many people towards ETF. If you do not get fair buy price and fair sell price, then you not just that cost advantage evaporates, you are likely to actually make losses. Now, I'm not talking about loss of capital value. I'm talking about the loss compared to if you would have got the fair value for your buy and sell transactions. So market depth is probably the most important reason why I say ETFs are.
Okay, Amol, in a nutshell though, do you really think that the market depth would have such a profound impact on the returns from this instrument?
Oh yes, why not? So and again, let me bring one more angle over here. So again, probably last month, one more time the data was released, and 50% of the investors have holding period of less than 2 years in equity mutual funds in India. Now imagine 0.5% or 1/4% of the premium you pay during buy transaction, 1/4%, 0.5% premium that you lose during the sell transaction. Overall your hit is somewhere between 0.5% to 1%. Now if you are a 1 year or 2 year horizon investor, which 50% investors are going by the data, then your annual hit is somewhere to the extent of 1/4%. And as I mentioned, this is pretty large. Now if your ETF has a 3 paisa expense structure, and if you invest instead of ETF, you invest in an index fund. Now, I can tell you there is a Nifty index fund available at 10 basis point or 10 paisa cost structure. then the maths very clearly says that you will probably take a 10 to 12 paisa hit per annum. And I don't think you should do that. There are other aspects. Most people use mutual funds for the simplicity that it offers. If you have to continuously monitor your buy and sell price as well as do the transaction in demat, most of the people are not used to buying mutual funds in demat form. Then I think compared to all of these, the cost advantage largely gets negated.
Okay. Okay, let's switch topics now, Amol, and talk about underperforming large cap funds. What should investors do with some of these? Now, one of them that stood out was DSP 100, if I'm not wrong, DSP Top 100, DSP 100. What's happening with this fund? Any reasons as to why it is underperforming? And what should somebody do if she or he has a subscription, has this fund in the portfolio?
All right. So while putting together this show, I think we have seen that and especially I think we worked on it when market touched 50,000 or those levels. DSP Top 100 being one of the largest scheme with asset under management of in excess of 2,500 crore rupees, it delivered close to 13% of 5-year CAGR. As against that, the top scheme had around 18% of 5-year CAGR. That is 5% CAGR over 5-year period. That is significantly large. As well as the benchmark of BSE 100 total return index, that fund, the benchmark probably delivered around 3 to 4% higher. Now, in my analysis of this fund, I will have to take you back exactly 1 year in time. So during March, the fund had 50% of exposure towards financials. So banks and financial services put together. In fact, it was 50.50. So it was something like 50-51%. Now, we remember very well over last 1 year, there have been 2 phases of underperformance for the banking sector. The Nifty took off from the bottom of 7,500 and banks took close to 1 to 2 months of underperformance to catch up with the Nifty. And again, during the pre-budget sell-off, the banks sold off quite substantially. After that, banks have picked up. What the fund has done, the fund has pared its banking and financial exposure from 51% of March 2020 currently to hardly 28-29% or so. So I would say the sectoral allocation probably was something that contributed to this 2-3% compared to benchmark underperformance, number one. Number two, you also have to understand what kind of a fund that you are investing. Now, Top 100 clearly says that fund looks for 2 factors. One is growth drivers, and second one is valuation comfort or valuation support. So the fund kind of also doesn't invest in out and out quality or out and out growth companies. Now here I'm saying that something that completely runs away, typically that is momentum stocks. This fund has less exposure to those because of the construct of the fund that mandates it to have some kind of valuation comfort. Now what investors should do? Let's again go back to the returns. The returns are close to 13% 5-year CAGR. These are by no stretch of imagination, these are not low returns. The only thing is the fund has probably not done well compared to benchmark. Now the standard modus operandi what you should do when any fund underperforms the benchmark is you have to go in detail of why the fund does so. Either you or your advisor will do this. You have to look at sectoral allocation, and if the sectoral allocation is not up to your liking, ideally the fund manager decides that, but if you have your own view, then probably there is a case to switch out of the fund. If not, then it, by the way, it cuts both ways. Now we have recently seen the coverage about a couple of large cap funds, couple of blue chip funds that had large exposure to the largest PSU bank. Now that PSU bank hasn't really done well over the years, barring last few weeks. In last few weeks, it has given chart-busting returns. The stock price has probably doubled in last few weeks or a couple of months. Those funds which were underperforming all this while are suddenly over a 1 month or a 1 quarter time horizon, those funds are suddenly back into limelight. So this is very tricky. I would say as long as the fund does a good job of managing as per the fund management strategy, which is widely declared, and it delivers something over and above the benchmark, I think you should stay invested. If not, then you probably have to look for other options.
Okay, so well, let's think of not really other options, but let's think of funds which are good from an investing perspective right now, Amol. From the plethora of, or not the plethora really, let me not assume, but from a small variety of funds that you might be recommending to your clients, which is that one which, from a size, from a timing perspective, looks a good fund to invest in, and why?
Again, Neeraj, very good question. Thank you. And especially the word that you mentioned, from timing. So timing, we are all used to talking of timing or using the terminology in equity. But they based on valuation, based on your targeted return. Here, I want to use the timing terminology for debt. Now, it's not timing of entry or exit. It is timing of the year. So we are somewhere in the middle of February. In a short while, 1.5 months from now, you will go to the next financial year. What's so unique about it? So unique about it is, if you invest in your chosen debt fund, obviously when I say chosen, I'm talking about something that fits your investment horizon, something that fits your rating profile. If you invest in a debt fund, only by investing into it for 3 years and couple of months, you'll be able to get benefit of 4 indexations. Now, 4 indexations, I'm sure, Neeraj, we have discussed this indexation topic many times. This is one of the tax advantage that debt funds or fixed income mutual funds enjoy. Now, coming to the fund offering, actual fund offering, I want to talk about IDFC Corporate Bond Fund. That's what I would recommend to somebody who has 3 years of investment horizon. Very quickly, IDFC Corporate Bond Fund. IDFC Corporate Bond Fund employs roll down strategy. So if a fund during the starting phase, the fund was launched in 2016, it bought the AAA rated papers of 4-year maturity that obviously matured in 2020. When the fund started, it had a YTM, yield to maturity, of 8.25%. So YTM minus expenses, it's somewhere around 675, 680, 690 kind of a return. And the fund delivered exactly that. YTM minus expense is much talked about and less understood concept. It doesn't work in all the funds because there could be other factors like credit event or interest rate movement. These two factors can upset the equation of YTM minus expense. This equation can get upset. It doesn't, however, get upset if it's a roll down strategy and if you do not have any credit event. This fund, being a 100% AAA rated fund, avoided all of that in a 2016 to 2020 period and delivered around 775-8% CAGR. Currently, if you have a 3-year horizon, you'll be able to invest into this fund and get 4 indexation benefit. And the fund currently is completely, right from the beginning as well as today, is a 100% AAA strategy. So I would say, if you're a risk-averse investor with 3 years of investment horizon and looking for debt allocation, I think this is the fund that you should look at.
Okay, Amol, we'll leave it at that. Thank you so much for taking the time out and speaking with us and giving us. Actually, just a small disclaimer, Amol, by recommending this fund, you or your firm, do you have any commissions coming out of the fund house in any fashion whatsoever?
Right. So I am a mutual fund distributor. We are ARN holders. Investors who invest through us, there is a commission factor. However, all the viewers that are watching can probably take help of their advisor if they are investing on their own with their research, and if any inputs are taken from here, and if they do if they invest in direct plans, there is absolutely no commission involved for their own investments.
Okay, Amol, we'll leave it at that. Thank you so much for taking the time out and speaking.
Always a pleasure. Thank you, Neeraj.
And viewers, thanks for tuning in to this leg of the Mutual Fund Show.